15 years ago, banks told themselves fintech was a fad. They said it was hype, that their customers weren't asking for it. And then they lost market share. Today, I'm hearing the same language again, but this time it's about stablecoins. And the question isn't whether stablecoin matters, it's whether financial institutions are about to make the same mistake again. Hello, everyone, and welcome to Icebreakers in Fintech, the podcast where we thaw out the cold, confusing world of financial technology. I'm Payments Elsa, and each episode, we're breaking the ice on the trends shaping how money actually moves. Payments, rails, artificial intelligence, banking infrastructure, and the innovations everyone's talking about, but not always explaining very well. If fintech ever made you feel like you needed a decoder ring, you're in the right place. We're here for the real conversations, clear explanations, and insights you can actually use. So get comfortable and let's break the ice on the future of finance. Let's start with something uncomfortable, because the payments industry has a short memory and a tendency to rewrite history in ways that feel less painful. Over 15 years ago, many banks and credit unions looked at fintech and said, "This isn't for us. Our customers aren't asking for it. We'll wait and see." That felt prudent at the time, but while institutions waited, fintechs moved. They didn't build technology for the sake of technology. They built better experiences. And over time, that shift mattered. So what actually happened? Well, here's the part that often gets glossed over. Banks and credit unions didn't lose ground because fintechs were flashy or disruptive for fun. They lost ground because customer expectations changed, and fintechs just responded faster. Over the last decade, non-bank fintechs captured meaningful market share across consumer payments, across digital wallets, and across lending and embedded finance. This isn't because customers stopped trusting banks, but because they wanted faster onboarding, better digital tools, easier money movement, and just overall better user experiences. Fintechs didn't create the demand, they simply answered it. And the result is banks and credit unions lost market share, compressed margins, and there was a wave of consolidation across the financial services industry. Now, listen closely to how stablecoins are being discussed today, whether it be at conferences or in the press or at association meetings. It's crypto hype. It's speculative. Our customers aren't asking for it. We'll wait. If that language feels familiar, it should, because it's the same instinct. Dismiss first, investigate later. And that's where financial institutions get into trouble. We need to do a reality check, and it has to be supported by data. So let's ground the conversation. As of today, there's over $100 billion in fiat-backed stablecoins in circulation globally, being used to move real value, not to speculate, but to settle transactions, manage liquidity, and move money across ecosystems. That usage didn't happen overnight. It exists because cross-border settlement is slow and expensive. Businesses want certainty and availability, and markets increasingly expect near real-time movement of value. That's not hype, that's demand. So what are stablecoins and what aren't they? Let me be very clear about what I'm not saying. I'm not saying that banks and credit unions should become crypto traders. I'm not saying that institutions should chase speculative assets. I'm absolutely not saying stablecoins should replace deposits or core banking relationships. What I am saying is stablecoins represent a payment instrument, one that introduces faster settlement, always on availability, and programmability into how money moves. Those are infrastructure capabilities. And as we've learned, infrastructure shapes behavior. Here's the strategic mistake that institutions keep making. They wait for customers to ask for technology, but customers don't ask for rails. Tell that to the banking executives that say no one ever walked in and asked for a FedNow payment. They didn't walk in and ask for an ACH either. Customers and account holders ask for outcomes. Speed, certainty, and availability. We've already seen this play out with instant payments, where trillions of dollars now move annually across instant rails in the US, proving demand long before many institutions felt ready. Stablecoins are sending a similar signal through a different channel. History is trying to teach us something. The lesson from fintech was never adopt everything. The lesson was ignoring structural change doesn't stop it. It just removes you from the conversation. Stablecoins may not be right for every institution today, but refusing to understand or investigate them at all, that's not caution. That's abdication. If you work at a bank or a credit union, or even a fintech, this episode isn't about fear. It's about curiosity. Because the institutions that survived the fintech wave weren't the loudest. They were the ones that paid attention early. Right now, stablecoins are developing into a new movement and infrastructure in financial services. The question is whether financial institutions are listening, or whether we're going to have this same conversation all over again in 5 to 10 years. That wraps up this episode of Icebreakers in FinTech. If this conversation helped melt away some confusion around fintech, payments, or how money is evolving, be sure to follow, subscribe, and share the show with a friend or a colleague who's still asking the question, wait, how does this actually work? New episodes drop with fresh perspectives, practical takeaways, and just enough spice to keep fintech interesting. You can find more clips and conversations across all of my channels at Payments Elsa. Keep asking smart questions and don't let the buzzwords freeze you out. This is Icebreakers in FinTech, and I'm Payments Elsa. Stay curious.